How's it, traders, and welcome back to Paradigm Flip. Hope you're all doing well. We're going to be talking about a couple of interesting things, so stay tuned for the video. So we are here on Euro USD on a 30-minute chart, and we got a few things on the screen here, and you'll notice that we have a moving average. Now, what I wanted to talk about today was knowing when to stay out of a trend. We all know that the trend is your friend, and I'm a big fan of trend trading, and it's always best to go with the trend. However, there are times when we should be going against the trend, and we're going to be talking about when that is, right? And if you just have a look here on Euro USD, we have a moving average, right? It doesn't matter what moving average you use, right? But you really want to try and find one that's not too large, like a 500 EMA, right? The moving average I'm using is just a 20 EMA, and it's a really good moving average when momentum trading, right? It can really tell you the direction of the trend and the momentum of the market, right? So I prefer to use the 20 EMA. Now you'll notice that right now Euro USD is actually topping out and we actually getting a turnaround, okay? And this was foreseen, right, before the fact, right? And I'm going to show you how to do that, okay? Now we can see that Euro USD was in a clear uptrend. We had this very strong move higher, right? And then we had this pullback, right? Nice tight range, and then we had another impulse move upwards, right? Now, what you'll notice is that when we're looking at price, right, and when we're looking at the moving average of price, right, you'll notice that price tends to move away from the average, right? And when we are far away from the average, right, this is normally an area where everyone is basically long, okay? And this is the area a lot of retail traders tend to jump into the trend, right? Near the top, a lot of good traders, right, may catch the trend a bit more early, okay? But the vast majority of retail traders are going to be trying to buy, right, near the top, okay? What usually happens is that they'll find an entry somewhere near the top of the move and price will pull back against them, right? And possibly scare them out of the trade or stop them out, and then price will sometimes continue or inevitably reverse, right? Or possibly continue without them. Okay. Now the reason for that is because they are entering or buying at a high price, right? Now we can tell that price is overextended, okay, by using a moving average. Okay, moving averages are normally used to identify trend, and we're going to be looking at how to use it in a different way. Okay, and we're going to basically use the moving average to tell us when price is overextended. Now, how we do that is by simply looking at the space between the average. Okay, when you see that the space between price and the average is very high, as in this case, right, you most likely will get a reversion back to the mean. Okay, this is an area where contrarian traders, right, are going to come in, right, and anyone inside this move is going to take profit. Okay, and whoever is buying at these higher prices will most likely be caught holding the bag. Okay, and you want to avoid being a trend trader in this area. You want to try and trade with the trend closer to the average or a bit lower in the trend. Okay, it could be any average, right? The average is just there to help you or guide you, to help you visualize, right, when the trend is overextended or not, right? And it could be any average, so it's a subjective thing, right? It's dependent on your trading style and what you're comfortable with, okay? And I found the 20 moving average works very well for me, right? But what we're trying to do is find where price is overextended, right? And we want to avoid trend trading in this area, right? This is an area where trend traders get trapped, okay? And we can see that happening at the top here with Euro USD. You can see there's this space between price and the average, okay, right? The trend has already moved, okay? If you wanted to get in the trend, you would have wanted to get in around the area on the pullback closer to the average, okay, right? And catch that move higher, Okay, but as of now, you can't expect price to continue rising forever. Now it could, there's nothing stopping price from going higher, but on a statistical basis, right, more often than not, price will always revert back to the mean before continuing or reversing altogether. Okay, so when we see this space between the average, right, we're going to expect that top to form, and this is around about where we can anticipate or expect that pullback to happen. Okay, now you don't just jump in willy-nilly, right, into the reversion. Okay, what you want to do is obviously wait for your confirmation. You want to see price slowing down. You want to look for your patterns, your entry patterns or your reversal patterns, right? And you want to find that setup on a lower time frame and try and capture this move coming back to the mean. Okay, now I'm going to show you how we can do that, right? And because this is a trend, right? When price is overextended, a lot of trend traders will tend to get trapped in this area. So what I usually look for is a trend trap. Now, what a trend trap basically looks like is price trading above a previous high, right? And we get sellers coming in, right? And price is absorbed at this level and we get their rejection. At that point, we know that there's a seller there, okay? And trend trade, whoever traded on the breakout or any trend traders in this move, right, are going to be under pressure, okay? And they're most likely going to get trapped, right? And capitulate, right? And when they give up their position, we're anticipating that that's going to drive the trend lower. Now, if we just go into the lower time frame, right? If we just go into a 1 minute chart, right? And we just look at this area of price action, right? What we'll notice is this series of trend traps occurring around this area. So we can see that price sold off, right, at this high, right? And what do we get? We get a poke above the high and we can see that rejection coming through. Okay, price trades higher again and we trade above that high. Okay, and we get another rejection, right? And basically what this is a accumulation for the short side. Okay, now it could be a reversal, it could be a profit take. Okay, but what's basically happening here is that sellers are coming in every time price takes out a high and absorbing any buying at this point, right? And they use any buyers at this point to fill their sell positions, right? And that basically causes price not to progress any further, right? We get that absorption pin and then we get a rejection, okay? And they can do it multiple times, right? Depending on how much they want to accumulate, right? And usually it comes in threes, so you normally get this 1, 2, 3 step, right? It could be one, right? Or you could have just a straight reversal, right? A pullback and a reversal, or you could just get one rejection, right? And then a pullback and a straight move down, okay? And it could come in threes as well. Now, I won't get too much into detail on trend traps because I've already done a video on that, right? And if you haven't seen it, I suggest you go and have a look at that. I'll link it up here for you. And basically, what you want to be doing is you want to try and enter, right? When you start seeing or identifying, right, that these sellers are now coming in, okay? And there are a number of entry strategies that I use to get into these trades, right? And I'm going to share a few of them with you, right? The first one is an aggressive entry, right? So that would mean that we aggressively sell once we see that seller coming in, okay? And as soon as we get that rejection of the high, that absorption, right, we look to sell with a stop above the high. And that would be, for example, in this location. As soon as we get that rejection, right, we'd enter, right, in this location here. Okay, or you can wait for a bar to close, whatever you're comfortable with, and you're going to keep your stop above the high. However, we always have to anticipate that price either may not be reversing, right, and this is just a profit take, or we can expect an accumulation, and if so, right, we can expect a series of highs or at least one more high, right? It usually, like I said, it usually comes in threes, right? So if you are going to take this entry, it's better to take the entry on the third rejection, right? So you got your first rejection, right? You got your second rejection, and then on the third rejection, that's going to be the most probable trade that's going to go, right? And another way we can enter is on a momentum trade, right? So we wait for that impulse to come in, right? And then we wait for a flag pattern, right? Which is a reaccumulation, okay? And then we'll be looking to take an entry on that, okay? And note you want your entries all to be in the range of the accumulation, okay? and you're going to be targeting just outside the accumulation and possibly lower. Okay, and we can see that this trade does indeed go, right? And then we get a pullback into this level. Okay, right? We can see this is just a larger flag pattern. Okay, and we get a pullback into this area, right? And that's another possible entry that you could also take, right? And that trades below this low, and we get a rejection. And currently we had this pullback, and we are possibly trading lower, or we could go higher. But the most probable direction, right, is lower based on the reversion. Okay, and we have a idea that these trades can work out well because we know that statistically, right, when price is away from the mean, we can expect it to revert back to the mean, right? So we can expect these flag patterns or these pullbacks to have continuations, right? And if you want, you can simply just go back to the 30-minute chart, right, and just have a look at price. Okay, you can just go back in history on your own charts, and you can see that whenever we get a move away from, right, the moving average, okay, there's always a pullback to the moving average, right? You can see whenever we have this space between the moving average, we get this pullback to the moving average, right? So you can just look at all this space, right, between the moving average, and then we pull back to the moving average, right? When we have space between the moving average, right, we pull back to the moving average, right? And you can see on this bar here, right, there was a lot of space between the moving average, right, and the close of this bar, right? And we can see that quick rejection away, right, back towards the average. Okay, we can see these areas here, we move away, right? Right, we have that space, we come back to the average, right? Here we move away, okay? We get that space, we come back to the average, same thing here, we move away, right? And we have that space and we come back to the average. And you can just go through your price charts and see that, okay, we can see in this area here, right? We get this move away. Well, the first move away was here. We come back to the average. Then we get this large move away from the average here. We come back to the average. We get this move away here. We come back. And you can see this was a very large move away from the average, okay, at this point. Okay, so if you are looking for any contrarian trades with this strong trend, you may have gotten stopped out, right? And eventually, right, if you had picked the right one, right, based on whatever your confirmations are for your trade entries, right, you would have gotten a very good trade at the top here. That's why it's important for you to go back and look at the actual reversal points and possibly also look at the ones that failed and see how your strategy, if you have a reversion. So basically, everyone has a continuation kind of style of trading and also a contrarian style of trading, right? So what do I mean by that? We all have a way of trading continuations and reversals. So if you, for example, trade a breakout of a flag, right, or a breakout of a swing point, right, that's a continuation setup. And if you want to look for the pullback, right, and look for the bottom of that pullback, that's basically a contrarian strategy, right? The same strategy that you would apply on this pullback would be the same strategy that you would possibly apply at this top, because all you are looking for is a reversal, right? So there are obviously two types of entry styles or strategies, and that would be a reversal or a continuation, right? So you want to check if your strategy, your reversal strategy, right, filters out the negative trades and captures the good trades. Okay, and if we just go back in time, right, you'll find that more often than not, right, we get that pullback whenever price moves away from the average, right? We get that pullback, okay, right? We get that move back to the average, right? And so your job is to basically try and identify. The first thing to do is anticipate the top forming, right? And then identify a way to enter into the trade, right? That will give you a good enough risk to reward back to the mean, okay? And basically that's what you're trying to do. Now I gave a few of my entry my entry processes that I use for these kind of trades, and if you have your own, you are welcome to test and try, right? That's the whole point of trading, is so that you can test ideas for yourself and see what works for you and what doesn't work for you, right? Now I hope you enjoyed this video, right? I hope it added value to your trading, right? And if you did get value from it, Please subscribe for future content. Please hit the like button. And until next time, see you on the flip side.